Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, April 24th, 2020. And here are our top stories. Big firms get small business loans, and the energy sector braces for layoffs. Well, joining me now to discuss this and a lot more, Devin Banerjee, Senior Financial Services Editor for LinkedIn, and is also the editor of the This Week in Finance newsletter, which you can get on the LinkedIn platform. Devin, thanks so much for joining us this morning.
Always good to be with you, Jeff.
Well, it's great to have you, and I trust that you and the family are safe and you're locked in nice and tight in the quarantine. But lots going on. Stimulus 3.5, I think, near passage is the time we're recording this, but also some things going on with small business loans and big firms getting some bailouts.
Absolutely, Jeff. An extremely busy news week. So as always, full disclosure, we're filming this on Wednesday of this week. And right now, small businesses across the country are waiting with bated breath for the relief program for them, known as the Paycheck Protection Program. There's also another side program, waiting for those to be replenished. So right now, as of last night, Tuesday night this week, the Senate has passed a bill replenishing that program with about $320 billion in additional funding. The first wave of funding, which was about $350 billion, did run out last week. So there's this new pool to be replenished, and in addition to $60 billion also to replenish the Small Business Administration's disaster loan pool. So that will be sent to the that has been sent to the House of Representatives, expected to pass it, and then the president is expected to pass it. But what does all of this mean? Well, effectively, it means the race is going to be on again for this funding. We saw that funding go very quickly, April 3rd to April 16th, effectively. It's also bringing up some of the big issues that were contained in that first wave of funding. So number one, there have been a lot of allegations against the banks that were administering those loans backed by the government. Allegations of, preferential loan processing, some self-interested approach to the loan processing. So there are several lawsuits now from groups of small business owners and operators against some of those banks, including Chase, Wells Fargo, Bank of America, Bancorp, alleging effectively that they prioritize loan size over the first come, first served basis that was required by the government. So, bigger loans to process, bigger cuts, and bigger fees for those banks. So those are the allegations right now. People are also bringing up the issue that sole proprietors had the first time around. Their application process started a week after other small business owners and operators, so they had less time to apply, less time to get in queue for that relief. And then the big public backlash that came out this week after some great investigative stories by the AP and the Wall Street Journal and others, which were some of the not so small businesses receiving funding that first time around. So our viewers must have seen headlines about Shake Shack, for example. That was the largest by market cap receiving funding from that small business loan pool. Of course, these are publicly traded companies. And the argument is they have access to the capital markets. They could issue equity, or they have credit lines, bank relationships, other sources of funding besides the small business loan program. The parent company of Ruth's Chris Steakhouse received the most in funding among those 103 public companies that received the funding. So Ruth's Chris receiving about $20 million there. And so all those issues coming up again as this second wave of PPP comes to fruition.
Yeah, obviously disappointing. That money was earmarked, and there must be tens of thousands, if not hundreds of thousands of small businesses trying to survive. So that money was earmarked for these small businesses. And I get it, this is an imperfect system. But, and I'm not going to stand on my soapbox. To me, it's like, how do you monitor this money going out? That's my money, your money, citizens' money, the country's money. How do you monitor it to make sure that it gets in the right hands? And then there was another piece that I read that wasn't necessarily related to the PPP, but it was like the bailout of some of the higher education institutions, right? So some of the bigger Ivy League institutions got some money. I'm not going to name them because, I'm not going to. It doesn't make sense to name them. But as we've covered this week, I had Rick Seltzer on from Inside Higher Ed. There are a number of 2-year schools and 4-year schools that are struggling to survive. So it goes to me, tells me about prioritization and trying to prioritize and who actually is validating that this money is going to where it needs to be.
Absolutely. And the Treasury Secretary, Steven Mnuchin, says more guidelines will be put in place this time around. But this is largely an appropriations bill that's currently moving through the system right now. What that means is it's replenishing an existing program that exists, an existing law, the CARES Act, that's already in place. So you can't change a lot of that language or the systems, unfortunately. And now, even though round 2 of PPP has not yet been signed into law, at least as of this recording, there's already talk of round 3, that the runway extended by this program to businesses only lasts a couple of weeks. And that's only for the businesses that can get their applications approved and actually receive the funding. So there is talk of round 3, and at least there is this chorus of voices and these lawsuits, as I mentioned, coming to the fore, trying to improve this process. I'll just mention a couple more data points I found interesting.
Sure.
For public companies, again, 103 of them receiving funding, because there is this argument that, look, a lot of these are actually smallish companies, if not the traditional definition of small business. So majority of those public companies do employ fewer than 150 people in total across their locations and their subsidiaries. The median market value or equity value of those public companies that received PPP funding is about $38 million, so not huge companies. And the median loan that those public companies received was about $2.8 million. So we don't want to cast all public companies, into this kind of dark image that they shouldn't be tapping programs available to them. But yes, there were those big examples. And I should say Shake Shack, Danny Meyer, of Union Square Hospitality, the owner, did decide to return the $10 million in funding that they received. That was after some of the backlash. So who knows what they would have done without the backlash. But to your point, there's a lot of moral questions coming into play, even if the rules aren't written so that you can't access this funding. A lot of corporate leaders and boards, I'm sure, but even just owners and operators are thinking through whether to apply and when to apply and how to help other businesses that probably won't receive this funding.
It's interesting, and I only have about 2 minutes left for this segment, but I read something where large institutional investors like pensions and foundations, et cetera, are really putting pressure on some of these companies as well. It's almost like the activism that we talked about. And, we talk about sustainability, the ESG approaches. And to me, this is right out of this is the G and S, the S and G portions of maybe more S of ESG. So it'll be interesting to see how they respond.
Absolutely. And I think, as you and I were talking about last week, everything right now is kind of move fast, ask questions later. Yeah. But those questions are going to come up eventually. Why did you take this course of action? What were the criteria that went into that decision and the consideration? So everything will come back to people. And reputation in a crisis and in a downturn is really all determined by your decision making and what the receipts show. How the process of decisions came to be.
Yeah, I think there's lessons here. We're not casting aspersions here. I understand why these businesses and the hedge funds, private equity, looking for the they have small LPs, they're small businesses. They're looking for opportunities too, and I get it. I think if we're using taxpayer money though, we need to be very prudent because at the end of the day, you and I, our children, or at least your children, we're not having any, but all that they're going to be paying for this long after we're gone, probably, and the grandchildren. Right. So. A lot to think about. Well, Devin, it's a great story. When we come back, we're going to talk to Devin about energy organizations now feeling the strain, and they could be in position for more layoffs. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Devin Banerjee, Senior Financial Services Editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. Devin, thanks so much for sticking around this morning.
Absolutely, Jeff.
Well, we're going to go from stimulus or stimuli and PPP and talking about small business loans. Now we'll talk about the energy sector. Also very hard hit. Oil crushed over the last couple of days at the time of this recording. So the energy sector feeling a lot of pain.
Absolutely. Let's talk a little bit about just what happened in the oil market this week. A lot of people seeing headlines about negative pricing, historic collapse. So let's talk about that. Well, crude oil trades on, what's called the futures market. So contracts, trying to value future delivery. So West Texas Intermediate, WTI May contracts on Tuesday of this week fell negative for the first time in history, and actually quite negative, down to almost negative $40 a barrel.
Wow.
What did this mean, and why did this happen? And why did this happen? It's all about the supply glut and the constraints in storage. So traders effectively were trying to get these contracts off of their hands right before expiration of the May contracts, which was Tuesday of this week, at basically any price. The reason being, if they're stuck holding these contracts, they have to take delivery of the oil. The holder of the contract takes delivery of that oil. And as I said, the glut in oil has become so severe globally that storage capacity constraints have really are really constrained. They're either filled with oil or they're promised to other suppliers, other users. The WTI delivery hub, which is in Cushing, Oklahoma, there was a lot of great reporting on that this week about the inventories already being full, the rest of it already leased out to, as I said, other producers, other oil users. So effectively, producers and existing holders of these contracts were willing to pay people to take these May WTI contracts off of their hands. If they couldn't get it off of their hands, they would have this very expensive process of taking delivery, finding storage for that oil. So again, really a historic move. And the biggest issue, as I said, taking a step back, is all about supply. Even after those oil producing nations of OPEC and more, called OPEC Plus, agreed last week, as you and I have discussed, to cut production, it has still not been enough. The market is saying, based on where oil has been trading this week, the market is saying those cuts are not enough. Daily demand globally for crude oil is about, these are December 2019 figures, the latest available is about 100 million barrels a day. That's where the OPEC group, that's the figure they use to kind of peg how much they should cut. And still supply of crude oil globally is oversupplied by about 30 million barrels a day, a range of about 16 to 35 million barrels a day. So what does that say? Those cuts are not enough. Everyone is now looking to the June contracts and where they will price. Some of the experts we've been speaking to and my team has been speaking to say that those contracts could play out similarly, and maybe even negative pricing on those WTI June contracts. People are now looking to Brent crude, which is really the global marker for crude oil pricing. On June, on Tuesday of this week, Brent had fallen at one point about 30% during that day to levels not seen since June 1999. So again, a real glut in supply, oversupply, paired against this backdrop of a real cratering in demand. I mean, travel, energy usage globally, all of those oil producing activities or those oil using activities really taking a hit during this coronavirus pandemic. So a real confluence of factors that, as I said, are forcing some real historic moves in the oil market right now.
And so what that means is for oil workers, that means people working in derricks and on oil platforms, but also the businesses, Devin, that support the oil industry. There are people that build containers, that build the equipment, that do the steel. They're at risk. Their jobs may be at risk if we stop drilling for oil because we have this glut, right? I mean, I know that the president said yesterday or the day before that they were filling the strategic petroleum reserves with some of this because it was at historically low prices. But I think it was like 75 or 85 million barrels. Don't quote me on that. But even that's not enough to maintain demand. So there's concern here. And we don't want, if those people aren't working, it's like any other business. Then when we restart, we've got to restart the oil digging or the exploration. All those things have to restart. And there'd be a lag there.
The ripple effects will be quite massive this time around. The oil industry, employs here in the U.S., the oil industry and those that support it, as you said, employ about 10 million people. A couple of weeks ago, you and I were talking based on a Brookings Institution study about geographies in the U.S. that likely will be hit hardest by this downturn. Yep. And if you remember, we talked about Midland, Texas, Laredo, Texas, a lot of places in that Texas belt that are highly dependent on oil exploration and production. These have really been the epicenter of the shale oil boom here in the U.S. over the past decade. And these companies, these producers, called upstream companies in industry parlance, are really struggling. They have about $86 billion in debt coming due starting this year through 2024. That's according to Moody's. The midstream company, those pipeline producers and operators have about $123 billion in debt coming due the next couple of years. This is in many cases not going to be serviceable obligations. And so there's this balancing. A lot of times when the price of oil declines, people say, well, this is great for the consumer, all the way downstream to the pump when you're putting gasoline in your car, this should be good for the consumer. But the point people are making now is this is such a historic cratering, and it's threatening so many jobs and basically huge swaths geographically of the U.S. that that benefit is totally overridden. That benefit of potential lower gasoline prices or energy prices is really overridden by the employment that's threatened by this, and all those communities and local economies that are threatened by this. Again, I keep saying it, just historic, unprecedented crash in the oil market this week.
Yeah, really bad. And I think when people who always think about that one side of the coin, they don't think about the flip side, which is if you have a 401k or you own stock in Shell or Exxon, you're taking a hit in terms of your portfolio. So it's never a zero-sum game, right? It's always there's different pain is felt and spread in different ways within an economy, within a market. So I think ultimately things will get better over time because we just have to get through this, however long it's going to be. We keep talking about this, Devin, but I think it's worth repeating because we don't want to crush people's expectations. We'll get through this. We always have. We've gotten through very tough things as a country, as a globe, and we'll get through this, and things will eventually return to normal. We just do not know, some level of normalcy, we just do not know when that will take place. Is it second quarter? Is it third quarter? Is it first quarter of next year? Beyond. So more to come. Well, Devin, always a pleasure talking with you. Glad to have you weigh in. Really a treat. And I think want to encourage the listeners or viewers to check out Devin's newsletter. He and the team put it together every Friday. It's a really great read for all the latest news. You can find it on the LinkedIn platform. Devin, until next week, we will talk to you again very soon.
Sounds good, Jeff. Take care.
And that wraps up this episode of BRN AM. Have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and so much more, check out today's edition of The Morning Pulse. And don't forget, tomorrow, we've got our weekly show, BRN Weekly, where we have a very special guest, and we'll be taking a look back at our hottest and best segments for the week. You're not going to want to miss it. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired of the same old stuff.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.